Steve Ham, Rob Mara, Roger Lord, Randall Watt, and Stephanie Manchester Wilkie and Robert Mushin. The only person who's not present is Andrew Morgan, who's on vacation and informed me of the fact that he would not be joining us. We also have with us 3 members of UBS, Mark Shigoski, Dave Sears, and Ashley Martella. And we have the host of the meeting, the town clerk, Carol Wardell. With that, unless there's other matters that are pressing to get out of the way first, we'll start down the agenda. Anybody have anything that we need to announce? All right. Our first item of business then on the agenda is to receive a financial performance update from UBS. Each of you should have received the package that David sent along on Friday, which I then forwarded. David, if you want to kick that off, we're ready to hear.
David, are we going to put it up on the screen for everybody to see, or are we able to do that?
I think Carol has to let you share screens.
Okay, is it David that's going to be sharing?
Yes. Yeah.
Okay. Let me
Morning,
make you up.
everybody. Anybody get their shots yet? I was muted out before.
Yes.
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 Good. Yes. Yeah.
Okay, David, I made you co-host, so you should be able to share.
Okay, first off, can everyone hear me?
Yep. Yes.
Oh, good, good. I was actually trying to speak before it wasn't working, so I had to log back on and then get back in. So glad I figured that one out. It says I'm not able to. I'm trying to share the screen. So it says host disabled participant sharing, screen sharing.
Oh, I got you. Let me see if I can figure this out.
There are 2
Well,
David Sears on the screen, Carol.
There are, I know. Let me see if the other one has.
And I don't know why that is either.
We'll call you replicator, David.
It's actually, if you read closely, it's Davy Sears. So
Yeah, both of them say that.
There we go. Yeah, I don't know why it's doing that.
Are you logged in on your phone, Dave?
I'm not.
Okay.
I just
That's
click the
common
link.
for those that do. You see their name.
You do both.
Do you want to try me? If you want to authorize me, I could share my screen.
Just authorize everyone, see if that
Oh,
works.
it's working now. It's working now. I got it.
I told the other one, the other screen, that they could do it.
Nice.
Thanks, Davey.
You got it.
You got it.
All right. Can everyone see the quarterly market review?
Yes.
Okay, great. Okay. All right. So we'll kick it off with just kind of a high level view of what's going on in the world. Where we find ourselves in the middle of what we hope is a recovery. We were just talking about the vaccines. I think that the efficacy of the vaccines and the encouraging signs, the declining rates of hospitalizations, all of that is obviously good. But then when you put that alongside of a potential another stimulus bill, interest rates, at least in the short end of the curve, staying low and accommodative, and a household savings rate that's almost double what it normally is. So the people that actually have kept jobs last year saved at a very, very high rate, either paid down debt or saved money. So when you look at all of that, there's definitely the potential for a very strong second half of the year. But we still have some questions, and that is mainly, the job market. There's still, we're still nowhere near where we were pre-crisis. And so how long does it take to, get back to pre-crisis levels as far as the job market goes? What type of, what jobs were lost that aren't going to, be regained? Those are questions we still have, but it's hard to ignore the stimulus that's with us and will probably keep this market going throughout the year.
So to what David said, one of the things that UBS has changed their opinion on about a month ago is that we believe at UBS the pandemic in the United States is going to start winding down actually in June and July. And that's mostly because of vaccinations that are going on now. Johns Hopkins reported this morning on CNBC that by July of this year, we're going to have 400 million doses excess of COVID shots and vaccines. So we're going to be awash in vaccines by probably the end of July. So that should help the economy. And as David said, the stimulus is really important. Number one, I guess 1 out of 4 Americans are going to bed with not enough food in their stomach. But we're not sure if the stimulus is going to get the economy going. You can't mandate manufacturing, but we hope that better jobs come back to the economy from all this stimulus. But as David also said, the stimulus is going to keep this market going. David, do you want to go to the next page? Or?
Can you see this?
Yeah.
Sorry, it says your screen sharing is paused, so it's confusing. But anyway,
Well, no, actually, no, David, it's not. It hasn't moved. It's just on the same page. I was looking at my copy. We're on the main page.
Okay, just trying to. Let's see, maybe if I move it over to here.
There you go.
There you go.
There you go.
Okay, so apologize. This is really just a quick visual of last year. Obviously, a lot of green. A couple of the energy and real estate areas was red. But the biggest difference is that last year was a growth year. There's some huge numbers that came out from one side of the market, whereas value stocks did not nearly perform as well. So while yes, the overall market did well last year, it really just depended on how you're positioned. Traditional defensive stocks, dividend stocks, they really didn't weren't too exciting. A couple more stats here. So at the end of the year, the top 5 stocks in the S&P 500, Facebook, Amazon, Apple, Microsoft, and Google, represented 22% of the index, which is historically high. Those 5 stocks averaged 55% return last year. The rest, the other 495 stocks, averaged about 10% return last year. So that's what we call a very narrow market. You had to be heavily in those names to really keep pace, which, from a risk management standpoint, isn't necessarily what most people do. But we did start to see encouraging signs in the fourth quarter where that started to reverse. And so we saw, the other 495 stocks start to outperform, and that's happening this year as well. So those are good signs that I think that the market is becoming a little bit more normalized. And that's usually healthy in the long run. We don't want these 5 stocks just to continue to go indefinitely.
Mm-hmm.
So a moderately risked portfolio last year was up just over 10%. So again, that this year, when we think about it, not sure we're as confident, mainly because the bond part of the portfolio last year acted like stocks. Bonds were up around 8 or 9% because interest rates came down. Now we're facing the opposite scenario where we're either going to be what we call range bound or potentially rising interest rates. And that's what we've seen in the past few weeks. Interest rates on the longer end of the interest rate curve, those that drive mortgage rates, things like that, are starting to actually go up, which is good long term. That's a good sign that the economy is healthy and we don't have to be at 0 interest rates forever. But it will provide probably some volatility in the short term as the market adjusts to it. Any questions? So this is just a visual back to what Mark was saying about the stimulus, right? And so we have seen this dramatic bounce back, mainly from stimulus. This is just retail sales. A lot of that is online, obviously, and manufacturing is actually in expansion territory. Please stop me if there's anything anybody wants to go over. So really, since the beginning of the crisis, I'd say we've had this framework. It's probably not new to everybody. So far, we think we're tracking in the middle, the central scenario where we're going to see things normalize in the second half of this year. And as the vaccine rollout, if that continues to successfully occur through the second quarter, we think we're on track. The only difference here, that actually, I don't think it's here, but when we think about the upside and downside, the new piece of information is interest rates and inflation. And so just got done saying that interest rates are increasing. There could be two reasons why interest rates are increasing. It could be the good reason, which is economic growth, right? Strong economic growth warrants higher interest rates. That's how you prevent an overheating economy and a bubble. But if interest rates are increasing because of inflationary concerns and actual real inflation, then that's not a good reason. So there's multiple ways to skin that cat, and it's too soon to tell which is the reason. In our opinion, we think it's more than likely the anticipation of a very strong year because of all the stimulus. We recognize that money has been printed at unprecedented levels, and the Fed is comfortable with that amount of money, and the fact that interest rates are rising, the Fed is comfortable. If we get some inflation in the short term, the market is thinking at the moment that it's short term and not long-term runaway inflation. So that's our view as well, that it's more on the growth side right now than inflation.
And to the second inflation that David was talking about, the inflation that we're having that we think the bond market's reacting to now has to do with housing. Number one, I'm sure up where you are and across the country, housing is really getting bid up as interest rates go down and money is being printed. And the other one is the interruption of supply chains from China and across the globe. One of the scenarios that we talk about is just the shipping containers that come from China. The ratio of shipping containers from China to the rest of the world used to be for every 2 that went out of China to deliver manufactured goods, 1 went back. And if you looked at the Boston Harbor, you go down the Jersey coast and you look, the containers were piling up. Up until the pandemic, the Chinese manufacturers were able to build those shipping containers for $2,000 a container. Now the pricing has gotten so much that they're not making those containers. And the ratio is more like 4 to 1, containers coming out of China, coming to the North and South America and Europe, and the containers are sitting empty. China has started shipping those empty containers back, or Chinese manufacturers empty on their ships, which is very expensive. Containers have gone up, cost for Chinese manufacturers has gone up 300%. At some point, that's going to start hitting the consumer here until it gets straightened out. And the supply chains in the meantime are being disrupted because there's not enough containers going back to China to push out the goods to the rest of the world. So that's the kind of inflation David said that's not good. It's consumer inflation. So we're watching that.
So this page, just to finish up our overview, UBS put some expectations. So for this year, if you go back to those 3 scenarios that I mentioned, the central, the upside, and then there's the downside. If you want to think about the U.S. stock market, we still think that there's a little bit more upside left. Now, the S&P today is lower than this number right here because of last week's sell-off. But if things are even better and that pent-up demand really comes in the second half, and we don't get those big inflationary shocks, then we could see even more upside. And then of course we have the downside here, and that's really kind of where starting off, the fact that we have all the stimulus, but it's very temporary, and ultimately the real economy without stimulus is pretty damaged. That, in our mind, is how this downside scenario plays out. Still way higher than we were a year ago, but this just gives an idea of the range of possibilities that we think there are.
David, can you talk about the Swiss market index, why that's performing better?
So partly, the main thing is in anticipation of a weak dollar. So the one thing we didn't mention, but is that with all of the printing and potential for inflation in the U.S., the consensus trade, most people think that the dollar will weaken against other currencies. So if you think when it comes to stocks and other markets, there's obviously the underlying value of the company, but that has to get translated into a currency. And so that's more than likely the main reason.
And it's puzzling why people think that we're the only country printing money. They're all printing money.
Right.
Well, the interesting thing about that, Rob, is China has no central bank, so they're not printing it. They're just putting money into circulation
Right.
with credit. Yep.
All right. Just to kind of recap, I mean, in general, this is what UBS likes. I could tell you, one of the areas that our team has wholeheartedly agreed upon is small and mid caps. And so, this portfolio has a healthy 15% allocation to small and mid caps. They had a very strong fourth quarter and are leading the way this year as well, basically because they're cheaper than large cap stocks and they're more sensitive to that recovery. So, we think that that's a good way to stay positioned. Any questions?
You think we should be, this is Steve Ham. Do you think we should be increasing an allocation to small caps?
No. It's an area we like. Generally speaking, it's also usually a pretty small allocation to the portfolio because of the risk. And so while where we may normally be 10 to 12% in that area, we're currently at 15. And so we're comfortable with that allocation at 15.
Yeah, and that part of the portfolio has done extremely well. And right now it's about 23% of your overall equity allocation. And that's at the upper end of where we've been historically. So, we think you're certainly well represented there. The other thing to consider, though, even though we do like small and mid caps, we have to recognize that they've rallied substantially in the fourth quarter into this year. So whenever we see an asset class rally that significantly, there's always the potential for some type of consolidation or pullback. So at this point, we think the exposure is more than sufficient, and we wouldn't be jumping in right now with how well these have done any further than we are.
And as Ashley just said, we let it run from 15 to 23%. We're not asking to pare it back from the 23%. So we're okay with what is conceivably an over allocation of small cap at this point, based on the models.
Well, you say that we're at 23%?
Of the equity allocation. So actually this screen, we're actually a little higher. So if you're 67% equities and you're on this screen, it shows we're about 17% exposed to mid and small cap. That's about 25% of your equity exposure is in those areas. So you're definitely well represented there.
Yeah.
So here's the overall allocation, right? So we have a target of 65% in equity. So we're a little bit above our target, but it's kind of an overweight that we're comfortable with. And I think as Ashley mentioned, we're very comfortable with what we call the subsector allocation. So how much in large, mid, small, international, we think it's appropriate.
Well, from reading your report, it would seem that we should be trimming large cap growth a little bit and putting it into small cap.
Yeah, and that's actually, we haven't gotten to that point, but that is the one recommendation that we have. It's just a trim, like you said. And what I didn't mention is, aside from valuation, so UBS right now is neutral on growth and value. And that's how this portfolio is positioned pretty evenly. The difference, though, is that when we think about how to potentially defend against inflation, if we have it, there's not many good tools to do so. But one of the best tools to do so are large value stocks, specifically those that are more cyclical in nature. I'm not talking about high dividend utility type stocks. And that's exactly the type of large value that we own with the MFS manager. So because of that, we do think a slight shift, which I'll get to in a second, is appropriate, but nothing major. we still want to keep that balance.
Yeah, and the rationale there is if you look at the value index, by default, you'll get a higher allocation to sectors like energy, materials, financials. Financials are, probably the most positively exposed to rising rates. And so that's a way to play a recovering economy, to play, the associated increase of interest rates. As interest rates go up, especially on the long end of the curve, banks tend to have a higher spread, so they become more profitable. So this is a shift in anticipation of a continuing improving economy. And also the other thing I'll mention is not only do you have some exposure directly to growth, but if you look at the S&P 500 today, the S&P 500 right now looks quite a bit different than it did 10 years ago. And David touched upon it a little bit earlier that, you have fairly high concentrations to a subset of stocks, but the technology sector in general is a pretty heavy allocation. And so, just by going passive today, you are making the decision to have a higher allocation of those areas. So I think it does make sense to shift a little bit more to the value side.
Mhm.
Yeah, so I'll just kind of move on here, and I apologize. This page here was we're going to talk about year-end numbers, but this page here is the as of a
Right.
few days ago, right? So the portfolio is up a little bit so far this year, about 1%. Okay, so just talking value growth here, this is a good page to reference. And right now, we actually do have a very slight value overweight, 9.4% to the value manager versus 9% to the Vanguard Growth Index. And then the S&P is in the middle, and that's where we do actually have the biggest overweight. And so if we moved, our recommendation, like I said, was going to be slight. It was going to be 1.5% of the overall portfolio, which is about $200,000. Right. So
Just the equity portfolio or the total?
Of the total.
Okay.
And so what will end up happening is, and this would be from the growth piece, that would go down by 1.5%, and then MFS value would go up by 1.5%. So again, not a earth-shattering change, just a small tactical, because of where valuations are, because of potential for rising interest rates, we think that that's an appropriate move. Is that, I don't know if that was, if I explained that clearly. Is there any questions on the actual recommendation?
No, it's clear.
Would you state it again, Dave?
Yeah, sure. So we'll just keep it in dollar terms. I think that's
Yeah.
for action purposes. So moving $200,000 from the Vanguard Growth Index to MFS value.
Okay.
Mhm.
So just to talk numbers for a second, the last year, calendar year, the portfolio was just under 12%. All of the current managers, so I'll go backwards. So the fixed income portion, all the managers are either in line or outperforming last year. So we're pleased with that. Our international managers did well as also overall. We have an index, and then we have a mixture of complementary styles. For, like you could see the Oppenheimer, which is growth, did really well, up 22% versus 10. So that section did well. Our small and mid cap did well. All of the current pieces of the portfolio, there's no issue. We had one underperforming manager last year that was replaced, and so that's really the story. So no recommendations on a manager level. It would just be that shift, that small shift in the growth to the value.
Ashley, do you have anything to add to that?
Yeah, the only thing I'll add, and this is something to consider, I mean, the fixed income side of the portfolio, as you can see, did extremely well last year. Bradford was up over 8%, Western Asset was up over 8%. Clearly, they're not doing that in the interest payments from the bonds that they own. So they were the beneficiaries, most bond managers were, to declining rates. This year, if we continue to see rates rise, obviously it's going to be a challenging environment for these managers. So I think it is good that we do have exposure to that BlackRock fund, which we added, which gives the manager a little bit more of an ability to manage that, I'd say, maturity exposure, the duration exposure of the bond portfolio. And so having that, we think, can be some protection in the event that, you know, rates rise further than even UBS is forecasting. So we think that, you know, on the fixed income side, it is going to be a challenge to generate returns going forward. But having a manager like BlackRock, you know, we hope that they earn their keep in a market environment like this.
David, can you go to the next page real quick? I just want to read into the record. The other thing is, Ashley, correct me if I'm wrong, we're not expecting the fixed income managers to have the same kind of returns they had this year. They had the tailwind of interest rates coming down, so we got equity-like returns in the fixed income, and we're not expecting that to continue into this year unless somehow rates start to go negative.
Yeah, I mean, if you look at the 10-year, you know, we're at about 1.5% right now taxable, and that's up quite a bit from where we were last year. But if you figure, you know, corporate bonds get a little bit of a spread above that, you know, maybe a corporate bond would yield 2.5%. Right. So last year, most of the return was because interest rates came down and bond prices went up. Even if interest rates don't move anymore from here, you know, you're probably looking at an average yield of 2.5% in a bond portfolio. So anything that would result in rising rates could impede even that return. So to Mark's point, chances are we're not going to get, you know, big returns from the bond side of the portfolio. But having a manager like BlackRock could add a little bit of what we call alpha to the portfolio above and beyond what traditional bond indexes provide. And we also have 2/3 of the portfolio in equities. And we do certainly expect equities, if the recovery is intact, to do okay this year. Probably not as strong as the last few years, but we think it could be an okay year. And we think some of last year's laggards, maybe this year's winners. And we've seen that so far.
Ashley or whomever, what happens how far would bond rates decline or bond prices decline with a 1/4% rise in interest rates?
So the way to look at it very simply is it's a duration, which is just an estimate.
Yep.
So let's say an average bond manager has a duration of 5 years.
Right.
Okay, so if rates go up 1%, that means that bond portfolio would immediately go down 5%. Okay,
Right.
so if it's a quarter, it's 1/4 of that. So you're looking at 1.25%. Okay, but
Okay, so if our risk is that bond rates are going up, why don't we put more in cash?
Well, the other, so there's a two-part, I just want to throw in. So also when interest rates go up, we just also have to define which interest rates we're talking about.
Sure.
So the Fed rising interest rates would not really affect this portfolio. The portfolio here, the average duration is about 5 years. And so it would be a question of what would happen on the 5-year part of the interest rate curve. If that goes up, you know, what happens to the 5-year bonds? Now, you know, Rob, the reason why we don't go into cash is because you lose your hedge. I mean, that's one of the reasons.
Yeah.
So, you know, not always, but when there is a crisis and the equity market falls by 20%, cash doesn't offset any of that. In some environments, bonds don't either. It depends on what type of bonds you have, but generally speaking, bonds go up in value when equity prices have extreme movement. And so there you have that type of hedge or ballast of the portfolio.
Yeah, and the other thing too is when we see rates rise, we'll see this periodically. We tend to get a spurt and then things level out. So we don't know. I mean, it's very possible that we've seen the majority of the rate rise we're going to see. We just don't know. I mean, we've seen a very quick rise and there's some fears out there that maybe it's inflation oriented. But I think a lot of it too is a lot of investors and traders front running the Fed, because the Fed has come out and said that they're going to let inflation run higher than the 2% level because they're going to target average inflation at 2%. And they haven't said anything that would indicate they're going to relax their easy money policies, which could be helpful to growth and it could be inflationary. However, let's say we see rates rise a little further. It would not surprise us for the Fed to come out and make a statement that indicates some sort of yield control.
Mhm.
And so that's the other side of it. And so it's very difficult to time these things. And if that were to happen, we could see rates come back down again. So, it's very tough to time this, but I think, if we look at the risk in your portfolio, I would say, right now you don't have a ton of risk on the rate increase side. I think it's more on the growth side, the equity component. And what we're trying to do is allocate the portfolio for what we believe is a recovering economy, a likelihood of modestly higher rates and modestly higher inflation as we go forward. But as David said, we just don't know. We don't know what the Fed's comments are going to be. We don't know how this pandemic is going to run its course, because we think that the economy will be strong for the next few quarters as the vaccine starts to get rolled out, the stimulus plan comes into effect, and this pent-up demand, a lot of individuals that have this high level of savings start to spend their money. We know that's going to run its course, right? So that may be transitory. And then the question is, as we get to the end of this year into next year, what does the real economy look like once the trading wheels come off? And we really just don't know the answer to that.
Mhm.
And so bottom line is, the time to have done that would have been obviously late last year. We've seen a pretty big backup in rates right now, but hard to say whether or not we're going to see much further from here.
What type of asset allocation does BlackRock Strategic have? Do we know how they would manage the situation of rising rates?
Yeah, David, I don't know if you want to
Yeah.
talk about that portfolio a little bit.
Yeah, no problem. So a couple of things on BlackRock. They have and actually, I don't know if you can see it. They have, so the portfolios in themselves, they're investing in a variety of high yield bonds up to a certain point. It's generally not over 25% of the portfolio. And corporate bonds and treasuries, and they're tactically shifting across them. I don't know. Can anybody see my screen?
Yes.
Yep.
Did it change?
Yes.
Yep.
Okay. So this is actually this is one of the benefits of of
Yeah.
being in front of your computer. So this is BlackRock, right? And so this is what I mentioned here. So if you look at the duration, okay, so what I was going to get to was a duration 3.41. So they're on the shorter end of the three managers that we have, and so they would be less impacted because, well, again, you have to think about it. What is the 3-year or 3.5-year treasury doing?
Right.
That's what impacts
Okay.
BlackRock.
Mhm.
Yeah, and then of course,
That's low.
the fact that they have this here, if you look at the double B and the B below
Mhm.
investment grade, 25% or so.
Right.
That's more sensitive. There's risk there, but it's not the same as interest rate risk. It's a
Mhm.
different type of risk. Right now, we believe that there's more interest rate risk than what we call credit risk.
Mhm.
And so we think they would probably fare the best out of all the three managers
Good.
in a rising rate environment.
And then actually, if you look at the top holdings also, you can see they have non-dollar denominated bonds. Some of these may be euro bond, dollar denominated, but they're not. So they also have sovereign debt in here that hedges against the dollar. And the other thing I want to point out, which you're going to see more and more, if you look 4 items down from the top, there's a BlackRock liquid environmentally aware tranche. If you've been reading the papers, BlackRock is pushing very much to be in sustainable investing. So they have a small portion, 1.12% of the assets in environmentally aware type bonds, but they're not showing what bonds they're holding because they're relatively illiquid. And they don't want to push the market up or down based on their buys and sells. So we're going to start seeing more of these kind of investments within the portfolio from the managers. Any questions on that or?
Good. Thank you.
Okay.
Trying to see if there's anything else here we want to go into.
This is a good way of doing it.
Yeah. Yep.
So we have one recommendation, but if there's no other questions, we believe the portfolio is positioned appropriately. This minor change is within the equity side, but the overall equity level of 67%, we think is where you should stay right now.
Any further questions from anyone?
What was that, Bob?
Sorry, any further questions from anyone?
Bob, do we need to vote on the change now, or?
Yes, I just wanted to see that there was nothing more before us, and then exactly right. Then I would entertain a motion to move 200,000 from Vanguard Growth to MFS Value.
I'll second it.
I'll take that as your motion, and then I'll seek a second.
Dylan, David?
It's not.
I'll second. Hello.
There we go. We got another participant in the pension.
That's David's Keebler's elves helping.
The motion then by Mara, is there a second?
I'll second.
Thanks. So the motion made by Mara, seconded by Leonard. We'll take a roll call vote. Steve Ham.
I just have a question. Of the 200,000, would it make any sense to split it between the large cap value and small cap? So you put 100,000 into each of those asset classes?
Let's go, I'm just going to go quickly to the. Sorry. All right, so just taking a look at where we are here, right? And so our, this is what I mentioned, our target is 13.5%, and this was as of year end, so these numbers are a little bit higher. And we're currently at, 15.8, almost 16% in the two. So it would be, increasing this modestly. I think, Steve, as Ashley said, the small cap indexes rallied pretty strongly. If there were a pause or a pullback, possibly. The Kane Anderson we like in the mid cap space, but they're also, generally we don't like the one manager, especially in the mid cap or small cap, to get significantly over 10%. So we're not looking to add more. Mark and Ashley, do you have any thoughts as to kind of, it's a small move. So really, I think that it's from a risk management, it's appropriate. It's not inappropriate, and it would be in line with some of our recommendations. But we already have the overweight here. Where we don't have a significant overweight is value. So that's kind of why we went there.
Yeah.
Okay, on with the vote.
So how would you like to vote? Aye or nay?
Can I abstain?
You can abstain if you wish.
Yeah.
All right, Ham abstain. Roger Lord.
Aye.
Rob Mara.
Aye.
Randall Watt.
Aye.
Stephanie Manchester Wilkie.
Aye.
Robert Mushin, aye. So the vote is 6 in favor with 1 abstention. Any other questions for UBS?
No, great presentation. Thanks.
Excellent presentation. And yeah, we may have to just make this a practice of.
Yeah.
I like it.
The technology is holding up, which is a positive, and that's not always the case, unfortunately.
That's right. That's right.
It is really good to at least be able to see everybody,
Yeah.
It's, in person, there's something to it, but this is a good in between, at least for now. So.
Yes, that's true. Okay.
So I have a local question. Is the concrete block where the Transformers live, the house, has that been sold yet, or?
No, they reduced the price to $5 million.
Yeah, if you'd like it, please let us know. We're to move that thing.
How much was it before 5 million?
8 million.
Wow.
What people don't realize, it's in the middle of cornfields. that get sprayed with pesticides, herbicides. And the man who owns that concrete house ran out one day yelling at the farmer who was spraying the fields.
So the Transformers really do live there.
Yeah. I mean, you don't want a house that you pay $5 million that gets sprayed by herbicides 5 times a year.
I might remind you, this meeting is being recorded and also is available on the internet.
Okay.
Opinions that are not those of the pension committee are segregated from those of other.
Good point.
But we're certainly grateful for your presentation. Thank you for the thoroughness of it, and for it's great to see all of you. We'll look
Yeah,
forward to
likewise.
the next chance.
Thank you.
Thank you.
Okay, thanks
Take
everyone.
care, everyone.
Good day.
Bye-bye.
The next item of business is to review the actuarial assumptions impact analysis that Angel provided. You should have gotten a one-pager in your email, and we'd look at that next. Thoughts as to how we might proceed? Mr. Mara, did you have one?
Yes, I like the second scenario. That seemed to be, a reasonable step up. I don't know if we could go part way this year before we decide on how much we ask in funds for this year's contribution. But I can't remember, it was only 6.7% increase or something like that. It was I believe it was 30-year amortization, and I believe it was scenario B. I'm working from memory here.
Well,
It raised it to 493,000. Our contribution.
it does raise it to 493, yes. I had thought and was in concurrence with your suggestion of scenario 3,
That's, yeah.
which takes a step in that direction, but would only go to 477 instead of,
Right.
instead of 493.
Right, that's right. I didn't have the chart in front of me, so yeah.
Yeah. Now,
Yeah, that looks reasonable
the
for a first
report
step.
figure that they cited would have us at 462.
Right.
So that would be a $13,000 increase in our pension contribution, which takes us down. Well, all of these take us down a quarter or more from our baseline, but takes us down to a 7% with a 2.5% salary growth. Both of those, I think, are certainly either we probably should go lower ultimately in long-term rate of return, perhaps, but the salary growth of 2.5%, I believe, accurately reflects historical numbers, and so I don't have any issue with that. It does take a step in that direction, and it gives us a bit more.
Yeah, and I think if we look at it again next year, it gives us the opportunity to step it down every year to the level that we want to be at.
Okay.
Because if we hold the salary cap at the 2.5, we may not go to the full 6.6 in the next year. We may have to go between whatever, I don't know, but certainly an analysis we want to do again next year.
Any other comments? Okay. What I was seeking in this particular item, and to your point, our next item on the agenda is also related to this, but in item 2 on the agenda, do we wish to direct Angel when they do the 2021 valuation to use 7%, 2.5% instead of what we've directed them now, which is 7.25%, 3%?
Yes.
Is that the consensus of the That is why we asked them to do it.
Right.
To get ourselves more in line with what we are seeking in terms of consistent values.
So Bob, if they use what we're recommending, scenario 3 or whatever it is,
Yes.
for next year, and they do the analysis,
Yes.
holding the 2.5 at 2.5, and see how we can step down to the recommended 6.6 or whatever it is next year.
Yep.
So that means in the letter where we ask the town, we'll have to ask the town for more money for this year. Is that the next step?
So today is the very last day in which we can submit a number. So item 3 on the agenda is in fact the vote for that figure, so that I can turn around at the close of the meeting and
Right.
send a letter on your behalf to the clerk asking for an amount. I feel comfortable with the idea that we would vote now to adopt scenario 3 values, that is a 7% long-term rate of return and a 2.5% salary growth for the next
Fiscal year.
yeah, but what's the term I'm at? I'm looking for the next time they do evaluation, for the upcoming evaluation. And then consistent with that, since they've told us what the number is for this year, the new number 477135, I would propose that the motion for item 3 on the agenda would be to adopt or to approve an amount of 477135 in lieu of what I sent you earlier.
I'll make the motion.
I'll second.
So the motion has 2 parts. The motion is made by Mara, seconded by Ham, that says we direct the actuary to use 7% rate of return, 2.5% salary growth for future calculations, and we vote to approve as the town's pension fund contribution for FY22 a sum of 477135. Is there any discussion on that motion? All right, hearing no.
Where is it? You said fiscal year 22. This is fiscal year 21.
No, we are proposing a value for fiscal year 22, which is the budget for the coming year. Fiscal 22 is the budget we will address at the FY21 financial town
All
meeting.
right. Okay.
Yeah. And then when they look at fiscal 21 with an actuarial analysis, which they will do this coming summer, they will use these new
Right.
attributes, not the ones they've used before.
Right.
All right, any further discussion? All right, we'll ask for a roll call vote. Steve Ham,
Aye.
Roger Lord,
Aye.
Bob Mara,
Aye.
Stephanie Manchester Wilkie,
Aye.
Randall Watt,
Aye.
Robert Mushin, aye. The motion carries 6-0, and that accomplishes both of those items on our agenda. Thank you very much. The next item of business for us is there are 2 invoices before you. One is the 3rd quarterly invoice. That's at the standard value of $221.25 for a quarter. The other is the cost of the study we've just been analyzing, which they have said would cost between $2,000 and $3,000, and in fact is $2,850. I would seek a motion to pay the 2 invoices to the actuary.
I'll second it.
I'll move it.
All right, thank you. Roger Lord moves that and Bob Mara seconds it. Is there any further discussion? All right, we'll again call for a roll call vote. Steve Ham,
Aye.
Roger Lord,
Aye.
Bob Mara,
Aye.
Stephanie Manchester Wilkie,
Aye.
Randall Watt,
Aye.
and Robert Mush and I. All I need now is a motion to approve the minutes of the 1st of February.
So moved.
Second.
Any further discussion? Roll call vote. Steve Ham,
Aye.
Rob Mara,
Aye.
Roger Lord,
Aye.
Stephanie Manchester Wilkie,
Aye.
Randall Watt,
Aye.
Robert Musson, aye. The date of our next meeting is the 5th of April. Is there any other matter that needs to be before us today? Very good. Thank you for being part of this. I'll declare the meeting adjourned as of 9:52.
Thank you.